Hey everyone, what I'm about to share with you is something that I'm always very excited to talk about, and that is building wealth and building passive income in real estate. It's what drew me to this industry. It's why I love real estate, and this is what I believe to be the ultimate guide to building wealth and building passive income in real estate. It's a strategy that's easy to do, easy to implement, very simple. You can do this whether you're new in the industry, whether you've been in the industry for a while, whether you're part-time or full-time. And we're gonna actually cover this in 3 different parts. First, I'm gonna show you a macro overview of the strategy and why you should implement this strategy in your financial plan. Then we're gonna go over some case studies, show you some properties that we actually ran through using this strategy. And then last, a plan of action. A very simple plan of action, show you how you can actually retire a multimillionaire in real estate with rental properties, and how few properties it actually takes to make that happen. So let's get started. Part 1, why you should do this. So it all comes down to retirement, right? We're all trying to retire. And the actual number you need to retire is going to depend a lot on the lifestyle you want, and of course when you want to retire. If you want to retire at 45, you're going to need a lot more money than if you want to retire at 65. But the $1 million mark, especially if you're going to be working into your 60s, the $1 million mark is still a benchmark that's touted by a lot of the financial gurus. Susie Orman actually just recommended recently a number much more than that, but we're going to stick with $1 million. That's what a lot of the gurus recommend. And if you take a 4% annual distribution, you're looking at $40,000 a year. Personally, I want a lot more than this, but let's stick with $1 million. How do you get there? Well, if you make $100,000 every single year and you live in Texas, at least as of right now, you're gonna have about 23% taxes taken out, so you'll be left over with $77,000. Other states with state income tax could be a little bit more than that, but in Texas, it leaves you with around $77,000. After with living expenses, roughly $48,000. Your mortgage, home, food, entertainment, family expenses, vacation, insurance, all that stuff. When it's all said and done, you're gonna have about $29,000 left over to save, and you can do with that with whatever you want. But if you save 100% of that, it's going to take you about 35 years to reach your $1 million mark. It's a long time. You start this in your 20s, you can make it happen. But if you're later on in life, it's going to be very difficult. It's going to be very difficult to make this happen. But there's a much better way, and that's the whole purpose of this presentation. Okay, before we go any further, I want to go over a few disclosures. I'm not a CPA, financial advisor, I'm not an accountant, I'm not an attorney. I am a business owner, real estate entrepreneur. I buy rental properties. I am doing the strategy that I'm going over with you right now in my business. I'm doing this right now. I've been doing it for a while. Anything that you learn here, take it to your financial professionals, see how it applies to your business. I personally think this is an amazing strategy that anyone can do. And your unique situation. You may need to do things a little differently to meet your end goals. So with the disclosures out of the way, let's move forward. A few definitions. Cash flow. Cash flow, very important with any business. It's essentially the amount of cash that's coming in and out of a business. It's what's left over after all when you have your income minus your expenses. What's left over is your cash flow. With a rental property, essentially this is you have your income being rent minus all expenses like your mortgage, insurance, taxes, HOA, any maintenance, and whatever's left over is your cash flow. Hopefully it's positive. Wealth. So wealth is assets minus liabilities. That essentially is your net worth. Your wealth. But this is a traditional definition, but I actually like this other definition better. It's something that I learned on, it was in one of the Rich Dad Poor Dad books. I think the first one, but it may have been Cash Flow Quadrant. And that defines wealth using time, which is really important because you can have all the cash in the world, but if your expenses are high, Like, are you really wealthy? So you can actually take your cash, your current cash balance, and divide that by your expenses and like your monthly expenses. And that's how many months that you could survive if you didn't have any new cash coming in. It's a very useful formula because it basically says how long you could survive if everything just stopped. But if you can implement some passive income strategies where income is continuously coming in whether you work or not, then if that income can exceed your expenses, your wealth is infinite because you'll never run out of cash. And that's ultimately what we're working on here, and what we're working on in retirement, because if you can do this from a retirement standpoint where your annual distributions are always lower than how much money is coming in to your retirement accounts, then you're continuously building wealth even through retirement, and you're going to have a great legacy, a great inheritance to pass on to your kids or your family, your heirs. All right, there's a lot of ways you can get involved in real estate and build wealth. There's certainly more ways than are listed here, but what I listed is 4 very common ways that folks invest in real estate. You can be a lender, a private lender, wholesaler, flipper, and then landlord, which is going to be the focus of this presentation. They all have their pros and cons. And as a matter of fact, you may implement multiple strategies. You probably will implement multiple of these real estate strategies. I do. So let's just look at a few of the pros and cons of each of them, though. So the lender, the private lender doesn't build equity. They do have cash flow because they're getting interest, at least if they're getting monthly or quarterly interest checks. They do have cash flow. They're not going to capitalize on appreciation. Not really any tax benefits. There can be some leverage opportunities for more sophisticated private lenders. The wholesaler, similar to the lender, with the exception of there's really no leverage opportunities for the wholesaler. Then you have the flipper. So the flipper does have equity. That's really what they're buying when they're buying a distressed property, is they're buying the equity. They can have cash flow if they have a predictable deal flow. So if they're buying multiple properties every single month, they can generate cash flow for the business. It's not passive, but it can be cash flow. Appreciation, sometimes, and then that's always a good surprise whenever you buy a flip property and the comps actually go up by the time you're ready to put it on the market. There's not really any tax benefits because it's all active income. Tax benefits outside of just normally just owning a business. But there is leverage. That's what makes flipping really attractive, because you can borrow other people's money, hard money, private lenders, to get into these properties with very little to none of your own money. And then there's a landlord. So the landlord is, of course, I have it highlighted for a reason. It's the best of all of these because the landlord builds equity. They have cash flow, predictable cash flow. They do take advantage of appreciation. There's tons and tons of tax benefits to the point to where they can actually be earning a lot of this income kind of tax-free. Talk with your CPA, but tax-free, and they can defer a lot of taxes and defer capital gains depending on how they structure the property when they eventually sell it. And then leverage, using bank financing to get into these properties, again, with little to no money out of their pocket. So let's dive in on that, on being a landlord. We're going to cover what I call the slow flip strategy. Another term for this is the BRRRR strategy. BRRRR standing for buy, rehab, rent, refinance, and repeat. But the reason why I call it the slow flip strategy is it's got a little twist to it. A little twist to help you exponentially increase your returns. But ultimately, it all starts out when you buy a property. If you don't buy any rental properties, you can't do this strategy. Kind of a simple point to make. So get educated before you buy properties, but ultimately get out there and buy a rental property. And the cool thing about rental properties is a lot of the information is known. Unlike a flip, you don't necessarily, you have to sell it and you have to make certain margins. And if you mess up, it's very difficult to basically make the gap on whatever the mistake is. If you mess up on your rehab budget or the actual sale price in a negative way, it's hard to make up that loss. But with the rental property, you're making your money over time. So, you're going to have the knowns of, what you purchased the property for. You're going to have a pretty good idea what you can rent it for through comps. Your rehab budget, pretty good idea on that. But even if that ends up being a little bit more, you don't have to sell it immediately to recoup your profit, because you're going to be renting it out and making that income over time. And then as far as the actual value, whenever you're buying the property, what you think it's worth when it's fully rehabbed, that is an important number, because it's very important to what you're going to be able to refinance into, your loan to value. But it's not vital in the sense that your profit is defined by it. So, but ultimately, you got to buy your property. Once you buy it, then you rehab it. Pretty common sense, because a lot of the properties you're going to be buying at a discount are going to need some level of remodeling. That's why you got it at a discount. If it was fully ready to go, which we've bought some properties that were almost or pretty close to being turnkey. It's very rare. They typically need some level of remodeling, and you're going to need to get in there and make it rent ready. But the cool thing is you don't have to do a full high-end remodel, or you probably won't need to do a full high-end remodel to get it rent ready. You just need to make it look like the comps that are available for rent. And you can actually save on some of those higher end fixtures that if you'd probably put in if you're going to sell it, but you're not going to sell it. So maybe hold off on that. And whenever you do end up wanting to sell it later on, then you can go back in and put those in, because you're probably going to need to do a final remodel at that point anyway. Then once it's all shiny, once it's looking good, rent it out. Pretty simple. We actually list all of our rentals on MLS. We love working on realtors, helps us get top value and rent it out very quickly. Right, next is refinance. This is where because you're typically buying your properties using private financing or hard money financing. The reason being, if you go with a private or hard money lender, and you buy it cheap enough, you can get into the property with almost no money or maybe no money out of pocket. That's really cool. And if you do that, when you refinance to your long-term lender, then they'll be able to refinance near 100% of whatever that loan value is. So ultimately, you don't have any money in the deal, great, increases your cash on cash return. If you go straight in using a long-term lender, like a conventional loan, when you buy it, you're going to be stuck with like 20-25% down payment. It doesn't matter how cheap you buy it. But with a refinance, this is what I recommend. You can actually start the refinance file at the moment you buy it. You don't have to wait until it's fully remodeled to start the refinance file. You will have to wait to actually order the appraisal, but go ahead and have that paperwork in, get it all into your lender, and get some of that stuff out of the way. And then once it gets to the point to the appraisal, just hold off on that part, and until you're done with the remodel. Then you tell them, hey, look, order the appraisal. And a lot of times, at least for us, we've got it rented out before the loan file even closes. And depending on what type of loan product you get, the rent income may actually may help you. It may count towards your debt to income ratios. All right, so you bought it, you remodeled it, you rented it out, you've got it refinanced. Now you repeat the process. This is how you build a portfolio. It's incredibly simple strategy to use, but I have an extra twist to this strategy, and that is selling it. So this is something that left off of the BRRRR strategy. This is why I call it a slow flip. Ultimately, we are trying to build wealth and build passive income. And you do that by acquiring properties, building equity, and increasing your cash flow on the properties as you eventually pay them off. But if you sell the property, you can't do that, right? Wrong. You actually can. And the way you do that is through accelerated returns and the velocity of money. So you're actually going to be building quite a bit of equity in these properties over time. Eventually, the actual returns on the property are going to diminish. At least in my experience, the faster the properties appreciate in value, the lower the returns you're going to get from at least a cash on cash return, lower cash flow. The reason being, taxes, insurance, maybe even maintenance will oftentimes increase faster than rent values. But the cool thing is those type of properties, whenever you do end up selling them, they will have gone up a lot in value. What do you do with that money? You reinvest it. And this is how you can turn one rental property into 2 or 3 others by taking the proceeds and buying 2, 3, 4 others. And you could typically buy them, actually putting some money down, increasing your cash flow, increasing your equity, but overall exponentially increasing your returns. So in part 2, we're going to go over some case studies. I'll show you some actual properties we've ran through this strategy and what the numbers look like. Stay tuned.